The robot, the tracker of your team. This player moves up and down the pitch with the run of play, tracking the movements of the game. In a similar way, a passive fund will track the movements of the market up and down. This robot looks for avoidance of serious mistake or losses. Their second aim will be freedom from effort, annoyance, and the need to make frequent decisions. A defensive investor runs and wins a race by sitting still. As the market moves up and down, rises and crashes, the robot takes control of the chaos. Their refusal to be active and building a permanent automatic portfolio with index trackers at the core can be the answer to every market question. This removes human emotion from the investing decision. The robot tracker. This defensive investor refuses to be active. They take control of the chaos, admitting that they have no pretend ability to predict the future. This can become your biggest weapon to put your investment on autopilot. They don't fall for the self-delusion that you know where the market is heading, or that you can understand what the next thing will be. By drip feeding the same amount every month, the ups and downs of the market become irrelevant. Pound cost averaging wins the day. Money goes into your asset column, whether the market goes up, down or sideways. Building a permanent autopilot portfolio means that whatever the market is doing, this defensive investor can always say, "I don't know and I don't care." This player moves up and down with the run of play, tracking the movements of the game. In a similar way, this robot will track the movement of the ups and downs of the market. When the average of the share price is up, the market and the tracker fund moves higher. When the average of the market is down, the market falls. This is known as a passive fund, as in theory you don't need to make any decisions about which individual shares to buy or sell, as you are just buying the average. From the outside, it seems like the easy option, just to follow the market and take a random walk, as historically shares will increase an average of 8% each year. So all you need to do is sit back and enjoy the ride. This is known as the efficient market hypothesis. This means that at any moment, all the information is available and known to the market. All the information is factored into the price of any share, and therefore the market is always efficient. The defensive or passive tracker will place their chief emphasis on the avoidance of serious mistakes or losses. Their second aim will be the freedom from effort, annoyance, and the need to make frequent decisions. They can take control of the chaos, refusing to be active. What you don't do is just as important as what you do. The cost of trading reduces your returns, as you have to pay broker fees, taxes like stamp duty, and the difference between the buy and the sell price, often called the bid-offer spread. This wears away at your gains, like rust eroding the robot. The more you trade, the less you keep. Time in the market and not timing the market. You need to have strength to ignore the overexcited commentators talking about the market, or other people telling you how easy it is to beat the market. Defensive investing is emotional, as you have to continue your course no matter what happens in the market. Picking your own companies to invest can be a lot of fun, however, it's not often recommended for most people. There is some evidence that index funds have regularly produced rates of return exceeding those of active management, especially when you take in control, including management fees. The three reasons why index funds have often said to outperform active funds are management fees, trading costs, and career risk. It has been said that a blindfolded monkey throwing darts at a stock listing of companies can do a better job of picking the companies than a city professional, getting paid an excessive salary, an expensive city office to pay, and paying for their over expensive lunches. Management fees are what you're paying these people to pick the companies that you think will outperform the market. When you think of the City of London, you think of expensive offices, expensive lunches and fat bonuses. These all have to be paid from somewhere, and often it's from you. The common practice is for active managers to take a percentage of your total money. Trading costs are charged every time you buy and sell. These are often hidden in the buy and sell price, and the more you buy and sell, the more you pay, and your assets get eroded. The final reason index funds is often said to outperform is due to career risk. Fund managers work in jobs and they need to pay their bills and mortgage payments. They have annual reviews with their bosses and want to keep their clients happy. So they often don't like to take unnecessary risks. The problem with passive fund is that they are boring. You can never go to a dinner party and brag about how your latest stock or investment has done. You can never show off about how clever you are or how much foresight you have by investing in a certain area. Now look, what are tracker funds?